I think, therefore, it's impossible to give a forecast what gold is going to be. But it's not going to be 10,000 or 12,000 in my view. It's going to have a lot of zeros after it in today's money.
But I believe that somewhere in that 125 to 130 price, industry starts looking for alternatives. So I know silver can spike to 200, 300, 400, 500. Okay. It could spike there, but I don't see long-term fundamental prices staying above 125 without the industry, which is now 50% of the market, looking for an alternative. Incredible. One of the best presentations I've ever seen on gold. And, I'm convinced, have been for a long time, that we're going to see $8,000, $9,000 an ounce.
Gold and silver markets continue to spark debate as analysts weigh long-term price potential. Some experts believe gold could eventually reach $8,000, $9,000 per ounce, driven by inflation, rising global debt, and increasing demand for safe haven assets. Silver, meanwhile, may experience sharp spikes due to supply shortages and strong industrial demand. However, analysts caution that if silver prices remain above $125 for an extended period, manufacturers may begin seeking alternatives because industrial use represents roughly half of total demand. Despite this limitation, the precious metals sector is expected to remain volatile, with both gold and silver benefiting from growing economic uncertainty worldwide. Now, we present the clips from Thayer's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I'm also on record for saying that between 6 and 12,000, but I add in today's money. And I think now I'm going to change my mind about this, because it is not worthwhile any longer to talk about today's money, because we're not going to have today's money. Nobody's going to see today's money. We are going to see hyperinflationary money. So to talk about 6,000 or 12,000 is meaningless, because what people have to protect themselves against is gold at 100 million or 100 billion or 100 trillion. We have no idea how many zeros there will be, because we have no idea how much money will be printed, but is not likely to be less, bearing in mind the massive exposure of the world economy. Just take the derivatives of 1 quadrillion outstanding, which most of them are worthless. So the money that has to be printed is probably more than we've ever seen in a similar situation. And therefore, it's impossible to say how many zeros there will be. But people must think in terms not of the fact that gold might go up 3 or 4 times from here, but the fact that they might lose all of their money because they haven't got it in a safe currency. And I think, therefore, it's impossible to give a forecast what gold is going to be. But it's not going to be 10,000 or 12,000 in my view. It's going to have a lot of zeros after it in today's money. The pressure on gold now will be twofold. One is the collapsing currencies. And then we talked about the dollar, but also every other currency will also go down, maybe not at the same speed, but they will do. So that's one pressure. The other pressure is combined with the fact that gold will go up just because currencies are going down, you have the pressure of that only 1% of world financial assets are in gold today. And in spite of that, gold has gone up 5, 6 times, depending on the currency, in the last 11 years, and which is quite amazing that you've actually seen a stealth market where gold has gone up so much without anybody owning it. Gold money has seen a major increase. We've seen very good increases in investment, but that's nothing compared to world financial assets. And, you're seeing now the first signs of people now becoming more desperate. People want to buy gold now, but it's still a very, very small percentage. But when major funds and major asset managers and major pension funds start buying gold, and they will also buy physical gold because they won't trust the paper market, which they shouldn't anyway. And when that starts, there won't be the gold around. And even the gold that they say is there won't be there, because central banks will not have the gold that they say they have, and it'll be lent out, etc. And therefore, the pressure on the price will be enormous. And this is what's going to move gold so fast. I think that they must have it outside the banking system, and they must have it in their own name. They must know that the gold is actually there. In my view, one shouldn't store it at home, because I think that's a bad thing. So your system or our system is absolutely the right way of doing it.
Analysts warn that gold's future price may be impossible to measure in today's currency if global monetary instability accelerates. Massive debt levels and an estimated quadrillion dollars in derivatives exposure could force governments to print unprecedented amounts of money. In such a scenario, currencies may rapidly lose purchasing power while gold rises sharply as a safe haven asset. Currently, less than 1% of global financial assets are allocated to gold, leaving significant room for institutional demand. If pension funds and major asset managers begin accumulating physical gold outside the banking system, limited supply could push prices dramatically higher in the coming years. Let's get back to the interview.
Silver in April of last year was $25.
Yeah.
And at your conference, it was $120.
Yeah. Yes.
What's interesting, though, is if you look at a leading silver equity like First Majestic, who has put out their earnings,
Yes.
what's so encouraging is the First Majestic share price was higher last week when silver was $70-something than it was when silver was $120.
Yeah.
And so we're seeing exactly what you articulated there. So the mining companies are now that their earnings are coming out, and we've had silver go from 25 to 120 back to 70 up to 90 today. So we've seen tremendous volatility, and what it feels like to me, being a student of the venture exchange and a student of commodities and commodity equities, it feels like a big run-up, right? It feels like a big run-up, but it feels like a wave of multiple waves to come. So
Yes.
I feel like, if you look at there was some news out of Shanghai last week where on February 27th, so in 2 days, Friday, unless you're an approved hedger, you can't essentially, because inventories are so low, the inventories at Shanghai are like 350 tons. You need to be an approved hedger in order to take your delivery at a future date. Okay. So what we're seeing what was essentially a speculative paper market turn into a real physical market, and it's because inventory levels are so low. But what's interesting to me is we used to live in a universe where there was a shortage of small metal. So 1 ounce coins,
Right.
10 ounce bars. And the big stuff it was easy to get. The small stuff was hard. That market's flipped upside on its head. And the dealers are now bidding small investors very, very low prices. And the big stuff is hard to come by. So everything's been turned upside down. And I think that's why you've seen the price take off the way it has. I do have a fundamental belief in silver, though. And I think some in the silver community may not like to hear this, but I believe that somewhere in that 125 to 130 price, industry starts looking for alternatives. So I know silver can spike to 200, 300, 400, 500.
Okay.
It could spike there, but I don't see long-term fundamental prices staying above 125 without the industry, which is now 50% of the market, looking for an alternative. Good news for mining equity investors, going back to your first point, we are trading as if silver is $40 today.
Yes.
So that hasn't been factored into the equity prices. And again, that may be like what I'm talking about may only impact 5 or 10% of the silver market.
Okay.
So again, with investment demand being 50% and maybe some like solar panel alternatives, you know. So I think again, but I'm just sensitive to the fact that I was banging, my fists on the table when silver was 25 and 30 and 40. But when it gets up to that 125 level, let's now focus on the equities versus the bullion. I think it's probably the opposite. It becomes more appealing as it gets higher. And more wanted.
That's investor psychology.
Yeah. And I just think that we're in an environment right now where I think gold's got more to run. I just had Ronnie Stofferly in my office giving an incredible, one of the best presentations I've ever seen on gold. And, I'm convinced, have been for a long time, that we're going to see $8,000, $9,000 an ounce. Based on Ronnie's presentation, I could see it going 2-3 times that price.
The silver market is experiencing dramatic volatility as prices surged from $25 to $120 before correcting and stabilizing near $90. Despite this movement, major silver mining companies like First Majestic Silver are still trading as if silver were much lower, suggesting significant upside potential for mining equities. Meanwhile, tightening inventories on exchanges such as the Shanghai Futures Exchange signal growing physical demand. Analysts believe silver could spike above $125 during strong rallies, although sustained high prices may eventually encourage industrial users to explore alternatives as manufacturing demand continues to expand globally. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.